There are a few simple tricks you can use to find trades that will profit like this Apple trade, and all of these other trades did. We're going to go through each of them, then walk you through exactly how we find trades like this. But first, some background. Why would someone want to trade implied volatility in the first place? Well, there's a few reasons. We use options to trade the level of implied volatility, and there's a natural edge in option prices. Options offer limited profits to the seller, but unlimited convex profits to the buyer. Because of this, sellers are compensated for selling options with a small statistical edge. After all, if options were perfectly priced, no one would want to sell them and take on this massive convex risk. But not only is there strong economic rationale for why sellers should be compensated for selling options, we also see it consistently across the historical data. The return of a delta neutral option strategy is based on the volatility implied by option prices versus the subsequent realized volatility of the stock. So if options have been consistently overpriced, there should be a spread between the implied volatility and historical volatility, which is exactly what we see. Over time, selling options has been a very profitable strategy. 2. Volatility is very forecastable. In markets, making money requires you implicitly or explicitly make some kind of forecast. Let's say you're running a value strategy and you deem a stock to be too cheap relative to its fundamentals. Maybe you use some factor like price earnings or debt to equity. Volatility also displays predictable patterns that we use to find profitable trading opportunities. And 3, unlike value investing, the fair value of volatility is always realized. To use a counterexample, if I buy a stock on the basis that it's undervalued, generally I also need some kind of catalyst to help realize that value. Other people in the market also have to recognize value to make the share price go up. If the market fails to recognize that this stock is undervalued, you're incurring a massive opportunity cost while you wait. When we trade implied versus realized volatility, we realize a true fair value no matter what the market thinks. That means if we're able to look for places where options are overpriced, it doesn't matter if other people recognize that they're overpriced as well. The fair value will be realized either way. Let's go through some tips and tricks, but if you want a more in-depth guide to selling options for profit, click the link on screen to get a free copy of our ebook. It covers all the critical details required to start making good money selling options. And right now, we're also offering a 7-day free trial for Predicting Alpha. You can click the link in the description and start your trial today. So we know selling options has generally been a good trade. The variance risk premium is like the equity premium. A rising tide lifts all boats. Being long stocks generally tends to make money, the same way that being short options generally tends to make money. However, despite the fact that a strategy of randomly buying stocks has actually performed fairly well historically, the more sophisticated equity investors, they don't just randomly buy stock. They look for factors that predict whether a stock is going to go up or down, such as price to earnings ratios or debt to equity ratios. They then create some kind of scan to consistently find these stocks and then create a diversified portfolio of stocks that rebalances every time there's a new big opportunity. So in our case, while we may be able to make money selling random straddles, we're looking to do things in a slightly more sophisticated way that allows us to outsize our performance, which brings us to tip number 1. Look for stocks where the implied volatility has historically outpaced realized volatility. The variance premium is auto-correlated. That is the fancy quant way of saying when options have historically been expensive for a while, they tend to stay expensive going forward. We want to find stocks where selling options has historically been a winner. To do this, we look for stocks where the mean spread between implied and realized is well over 1. As an example, we have DWAC. When we plot the spread between the two, we can see that implied has consistently been 20% higher than realized volatility over the past few years. Continuously selling a weekly or monthly DWAC straddle would have made you a ton of money. Ideally, we'd like to create a basket of around 5 of these stocks and sell volatility on all of them, because having too much exposure to one single stock is a dangerous game. Tip number 2, create a forecast of volatility. In order to tell what our edge is, we need to create a fair forecast of volatility. This forecast can be as simple as whatever realized volatility was over the last 20 days, or as complicated as the thousands of Garch model variants posted on SSRN every year. By creating a forecast, we're able to say, The straddle is trading at $10, it's actually worth $7. That means my edge is roughly $3 or $300 in return per straddle. Tip number 3, look for situations with risk to sellers and upside to buyers. I mentioned before how if you had the choice between buying and selling options with zero expectancy over the long run, meaning that they're just fairly priced, you would buy every single time. Buying an option protects you against the downside of a stock or gives you leveraged exposure to the upside of a stock. Take one look at Tesla, Rivian, AMC, GME, and you can see why you'd much rather buy calls than sell calls. However, these are the exact situations where selling options is often the better trade. This risk to the seller means the options have an even larger embedded risk premium. DWAC, the ticker we mentioned before, went on some meme-like tears over the last few years, and the option market remembers this and prices a risk premium that compensates sellers because of it. Looking for situations with risk is a great way to find profitable trading opportunities. Trading, like a lot of endeavors, is about focusing in on only the most important activities while minimizing the time spent doing less important activities. The Pareto principle, focusing on the 20% of inputs that translate to the 80% output. So what's a simple, systematic process that you can put into place to help you find more profitable volatility trades? Step 1, build scans that help you find the most profitable opportunities. Filtering for a high variance risk premium with high implied volatility can help you narrow in on the stocks with the most expensive options. Step 2, make a forecast. Whether you want to use a 20-day historical volatility as your forecast, try to create a Garch model, use some blend of these things like we do, creating a forecast of volatility allows you to calculate your trade's edge. Step 3, just start trading. There are hundreds of little details and nuances that you're only going to learn by trading. As backward as it might sound, there's no substitute for making mistakes with real money. So just try, fail, learn, and try again. By following these steps, volatility trading can be one of the most profitable and rewarding styles of trading. It makes you think differently about events in the market, which is a skill that can carry over into directional trading as well. So if you're an options trader, I highly recommend monitoring the volatility surface. There is a lot of valuable information there that can help you determine whether you're on the winning side of a trade.